Hello and welcome back. My name is Josh, and today I want to do a quick video just about the macro environment we're in right now. So typically I talk about stocks, which stocks I'm looking at, which ones I'm buying, but within the environment of stocks, we have to understand that there is many stocks are correlated, and they do better or worse given the macro environment. So what is the macro environment? It is based on interest rates, general sentiment, consumer demand, supply chains, um, a number of different things, political instability, a number of things can change the macro environment, the general economy and growth of the economy. And given the current environment we're in, uh, as you can see, here's a chart of um, inflation over the last 25 years. And it's typically been about 2%. But recently it's been much higher. It's actually been, if we look at just the last year, we can see here how quickly it rose from mid ones to 4, 5, and now all the way up to 6. Now this is a backwards looking indicator. This is saying what inflation was. It's also compared to its typically growth over the last year, and we saw here there was a massive dip during COVID. So yes, there was a 6% growth from when we saw negative, like very low inflation. So this is what you call the base effect. If numbers go down and then you see a slight increase from the base, which is 2%, it's actually going to look bigger because the gap between here and here is wider. So some people think that inflation is going to slowly slow down a little. However, on top of inflation, we also have supply chain issues. I'm sure everyone's seen this, where Apple and Amazon both reported that they're having supply chain issues. There's a chip shortage, and this is leading to not enough goods being able to be produced. There's also the fact that many people are, let me try and find this one, job openings. So there's actually a record number here. US workers quitting reaches record high job openings edge. So there's actually so many people that are looking for better jobs that we actually have a record number of job openings in the States. And that's actually leading to many businesses needing to increase wages in order to attract new talent. I was just reading about how they're now offering to pay for your tuition. If you go to university, they're increasing signing bonuses. So a lot of these businesses have significantly upped their wages, um, especially restaurants. Restaurants have significantly increased their wages to attract people, whether that's McDonald's, Chipotle. Um, this has led to some other areas of potential growth. If you actually, I talked about a company called Miso Robotics, which is creating a robot to replace some of the manual labor that's done in restaurants. If you want to learn more about that, you can check here. But there is a major labor shortage right now because people are wanting more wages in order to attract them to go back to work. And what happens is when you have, because Chipotle and all these things are having to pay their employees more, that's also leading them to increase prices. So prices are going up of products, and meanwhile, we're not actually producing more products because of supply chains. We're actually producing fewer products. So this kind of imbalance of more higher prices and fewer products means there's more dollars out there chasing fewer goods, which really is what inflation is. Inflation is uh, the increase, it's either more dollars chasing the same number of goods or the same number of dollars chasing fewer goods, so it increases the price. And we actually have the worst of both worlds, where we have fewer products and more money that's being pumped into the system due to money printing. And all of this to say is we have a macro environment which is very dangerous. Markets are at an all-time high. If we look at the NASDAQ, ticker, there we go. If we look at the NASDAQ, we're at all-time highs easily. Same with the S&P. So markets are at an all-time high. Real estate's at an all-time high. You know, stocks, crypto, everything's at an all-time high. And yet we have this environment where, because of high inflation, there is risk that the government would increase interest rates. Um, and interest rates typically, I've mentioned this in a previous video, again, I'll link it here. When interest rates go up, that typically brings down stocks and real estate because there's a stock premium. And so if interest rates now are 1 or 2%, and it basically impacts the price earnings multiple. And so higher interest rates means lower PE. You're willing to spend less of a premium to get that stock. So there's a major risk because right now, if we actually look at Shiller PE ratio, here we have the Shiller PE ratio, and you can see we're basically at an all-time high, other than some other points. Black Tuesday. This was the dot-com bubble. So we're at levels that we haven't seen since previous crashes. Again, I'm not saying there will be a crash, but I always say there is always going to be a crash. It's just a matter of when. Is it going to be next month, next year, 10 years from now, 5 years from now? No one really knows. But we are in an environment where there is a lot of risk out there. So I just want to make this video to let you know that certain kinds of stocks do better and worse in this kind of environment. Typically, high-flying tech stocks do worse when interest rates do creep up. So you might see a company like Tesla or high growth companies that are not yet earning profits. Those companies are more likely to get hit hard than a company that is cash flow positive. A company like a Walmart, a Procter and Gamble, and AT&T. These companies are less likely to get hit hard by rising interest rates. So how can you protect yourself against this? This is the number one key for any investor: diversification. I'm still long growth. I still am a big shareholder in Tesla and Google and Facebook. I guess now Meta. A lot of exciting growth companies. However, you need to balance that out with some solid companies that are cash flow positive, that are going to give you some stability should the market take a turn. Again, I don't know what the market's going to do. No one does. Anyone who says they do is full of shit. So don't believe them. But it is an inevitability. There will be a downturn. Again, I don't know if it's going to be a month, a year, six years. I have no idea. But you want to be ready. So the number one advice is diversify. Make sure you have some stock spread, not just in different companies, but in different sectors, as that will help you be able to, if there is a big correction and some stocks pull back a lot, like let's just look at Google quickly. When it pulled back significantly it dropped 30% when COVID hit. If you had some other stocks that you were able to sell, you were able to buy Alphabet, Google stock, at an amazing rate. So that's why I typically have a diversification, not because I actually think these companies are going to grow and do well, but I want them to produce some small amount of return. Typically, I like dividend stocks, so I get paid to hold the stock. Hopefully, it goes up. Hopefully, they're safe, good stocks. And if everything else crashes, I can always sell these stocks, which are more stable, and buy into the companies that saw more dramatic drops that I believe in the future. Because again, I have a long time horizon. So one key is diversification. The other suggestion would be to keep a little bit cash on hand. You don't want to be all in cash because some people have been waiting for the crash for 10 years. And if you looked at the S&P, some people have been calling it forever. And if you just sat out the market because people thought the market was going to crash, you did very poorly for a very long time. You would have missed out on 50% upside. So I do believe you need to be invested in the market, but just make sure, one, you're diversified, and two, you have a little bit of cash on hand. I'd say 5 to 10% is good, just so that if there is a pullback, you can deploy that capital into some undervalued stocks. So hopefully this was helpful. A bit more about the macro environment. What do you think is going to happen? Do you see that we're still going to be in a bull market for the foreseeable future? Do you see some angry tides on ahead and some pullback? So let me know in the comment section below. Thanks so much, and talk to you next time.